hitting 4-month low after traders learned 60 million more barrels of supply are coming onto the market. The U.S. and other members of the International Energy Agency are trying to offset production losses from Libya. Our next guest says it's political posturing. We're joined on the phone by Haag Sherman. He's CEO of Salient Partners based in Houston. And Haag, I'm guessing you're betting that the release from the Strategic Petroleum Reserve is more political than the IEA. Why would the IEA be doing this for political reasons?
Well, if you look at the IEA, it's comprised of mainly developed countries that are oil importers, with the U.S. being the principal constituent of the group. So if you look at what they're trying to do is assuage fears in the developed world about energy prices, but also it's a token gesture toward the emerging world where really dollar depreciation has driven oil prices, food prices, and other things and inflamed a great deal of unrest.
So you do not think that there are going to be supply constraints, or you weren't forecasting them for the second half of the year?
Well, if you look at oil usage, it's really been pushed by emerging markets. The developed world has flattened out, has actually declined in some places, but it's really the emerging world. But a nice piece by Bloomberg, the middle part of this month, pointed out that month to month, Chinese oil demand has fallen. And I think you will see that across the emerging world with oil consumption stabilizing and pressures from a demand perspective stabilizing with respect to oil.
So, I mean, it seems the bottom line is still going to be a negative then for energy shares, no?
No, I absolutely do. I think that slackening demand along with the end of QE2 will cause energy prices to continue to come under pressure. Obviously, this has taken a big chunk out of energy prices here. But if you look at the total being released, it's 60 million barrels. It's less than 3% per day of consumption. And so it's a drop in the bucket, literally and figuratively. And I think that, again, dollar depreciation along with demand, I think both of those are going to stabilize and put pressure on energy prices outside of this move.
So that's what's happening with the underlying commodity. But what about the Exxons of the world, the energy giants? How are you repositioning it all today?
Well, I think if you look at from a firm perspective, we've been lightening energy modestly before the burn off of QE2. Because a lot of, if you look at over the past less than a year, but since Bernanke signaled QE2, energy prices have surged from about $70 a barrel to $115 before selling off. We forecasted or projected about half of that being from dollar depreciation, which was really driven by QE2. So as QE2 wore off, you would see that underpinning to oil prices come out of the marketplace. And I think you're also seeing a slowing of global demand and a slowing global economy. So we've lightened our position, modestly over the last couple of months.
All right. Thank you very much for giving us your read. And we certainly are seeing others lighten their positions, not just in oil, but in energy shares today, among the biggest sector decliners.